joining us. Let's put where you're from in the chat. I'm going to start first. My name's Will McBride. Sometimes I like to be called Mr. Chameleon. I am from Bucks County, Pennsylvania. My partner's down below on my screen. I don't know where he's showing on yours. That's Dmitry.
Hey, everyone.
And up in my left-hand corner is Felix from Options Geek, a real special guest who's with us today. And he'll be telling us a little bit about himself. I know he's got a very cool website and puts out a lot of information to the options public. Felix, why don't you tell us a little bit about yourself?
Sure, great. Well, first, thanks for having me here. I feel privileged and honored to be with you guys. I love your website and it helps me out a lot on a day-to-day basis. But my career spans across the what's called the sell side and the buy side. I worked at the top investment banks for the first half of my career, 10 years, and then transferred over to the buy side, where I worked next to two of the most successful hedge fund managers over the last 35 years. Over that time, it's about, call it 21 years, I decided to leave to pursue this optionsgeek.com, and I created that. And really what I'm out there trying to do is trying to help the average investor close the knowledge gap between themselves and the top 1%. And, I'm really out there disrupting options education, trying to make it simple so that everyone can understand. So my messaging moves a little bit away from, or a lot away from, the Greeks and implied volatility, which is something brand new. But it's really the way the top guys in the world use options, and again, they use it in a very specific way. So that's what I'm doing with optionsgeek.com.
Wow, that is awesome. You're helping out a lot of people there, Felix. Let me ask you, how do you find, I know one big thing you like to focus on is, how do you find the best options to trade when you're thinking about a move in the stock?
Yes. So it's a little bit longer conversation, but essentially I teach that in my education. And it's really boils down to more risk reward and probabilities and odds, as opposed to the Greeks and implied volatility. And it's really a unique way to look at it. There is nothing available in the market like it. In fact, I've narrowed down options education to 2 questions. Okay, all of options education come down to 2 questions. When do you use options? Okay, when do you use options? And then after you decide when you use options, which option do you actually choose? Which option do you buy? I teach the way the top guys in the world use options, and most of the time, not Warren Buffett, but most of them are buying options for the leverage. So I teach people how to buy options, but in buying options, you have to choose. And that is the hardest question in options. And I've put my whole effort into giving that answer to the average investor. Not only do I teach new concepts, so I've created my own new concepts in options. And I then built a tool to bring that education to life. So that all comes combined, and I teach those the answers to those 2 questions.
Very, very, very interesting. One thing I saw in your bio, some of these big hedge funds you've worked with.
Sure.
I mean, how interesting, I know for all of our watchers, they're probably interested. I mean, Stevie Cohen was a name mentioned.
Yeah.
Ackman. I mean, that is, so
yeah.
Those are some big names.
I worked at Bank of America for many years. I was a risk manager at Bank of America, which is basically a volatility trader managing Bank of America's capital. And when Steve Cohen, Bill Ackman, Carl Icahn, Warren Buffett, when they want to trade options, they're not going to TD Ameritrade and pressing buttons. They're calling Goldman, JP Morgan, Deutsche Bank, and Bank of America being one of them, to give them a price, to talk strategy, to talk through whether sometimes it's over the counter, but anytime they're trying to trade something in that size, they need liquidity. And so Bank of America, with billions of dollars in capital, they put me on the post to manage that transaction. I was trading biotechs and semis. So when someone wanted to come in, a big trader of that in that sector was Raj Rajaratnam at the time. Okay, Raj was one of the biggest semi traders, with options in the business. And so he'd come in and he'd want to buy 5,000 micron puts right before, 2 hours before earnings. Those are tough trades. But because he was a customer of Bank of America, we were there trying to give him that liquidity. So I was selling options to Galleon, to Steve Cohen, to any of these guys at any moment in time for as big a size as they want.
That's awesome. And Will, I don't know if you mentioned, like, if it goes over 100, we're still on YouTube if somebody gets kicked out.
Good point, Dmitry. Listen, the way Zoom works, we have the opportunity to live stream to 100 people. We're actually above that right now. We're right at 100. So go to our YouTube channel, MarketChameleon.com on YouTube. Just do a search. We are live right now on YouTube. So Felix, do you have some ideas maybe you wanted to share with all the chameleons out there today?
Yeah, so I think, I think for the average investor, the questions I have is, how do you come up with an idea? How do you actually, you can have your own thoughts, your own charts, but how do you think about coming up with great risk reward ideas? And, a lot of people understand the power of unusual options activity. They understand sort of the high level thinking that those are the trades being done by the institutions. So I wanted to dig in a little bit further into that thought process. I wanted to give people, Market Chameleon is a very powerful platform. They have so much data. There's so much going on. But for the average investor, sometimes data is overwhelming. And so I wanted to leave them today with a few simple steps that they can do to get right into a pool of some of the best ideas in the market. Okay. And then from there, once they do that and they have in their hands probably 5 to 10 interesting ideas going on in the market every day, they can then use all the other data around it to support whatever thesis they're coming up with. So with that, I'd love to start showing them a framework of how we should be thinking about it before we tackle the data, because at the end of the day, data is data, but how we filter and how we manipulate the data to give us the answer is really, what we're looking for.
Awesome. So do you want to share your screen? Or
absolutely. Yeah. Let me get moving with that.
And one of the things I know, I talked to some of Felix's customers, and I like that, they ask like really good questions and they really think through trades, like not just look at, here's a big trade and follow it, but they really have like a process.
Right. So let's walk through. So the top 1% we've identified as some of the biggest hedge fund guys in the world. And let's try to figure out, because what I teach at Options Geeks, I try to teach, where do these guys get their advantage? Where do they have their edge? Okay. And the first and very, very easy one is the idea. How and where they come up with their ideas, okay? Whether it's using fundamental analysis, technical analysis, quantitative analysis, data analysis, whatever that is, how they come up with their idea, that's part of their edge, okay? That's part one, the idea. Once they get their idea, the second area where people might not know, but they have edges in deciding deciding if and when they're going to use options or they're going to use stock, okay? That is a decision that requires knowledge. It requires a process. It requires an understanding, specifically for them, risk reward. Okay, is stock a better investment or is options a better investment? And it's important to understand that not every idea is an options idea. Okay, that's very important to understand. Okay, so if and when they should use options. The third area where the top 1% gains their edge is in how or which option do they choose? Which option do they buy? Now, the top 1% generally, we said buy options. So which one do they buy? That's an area where they have edge. And in fact, I call that, let's see what's happening here. I call that the option secret. Okay, the option secret, it's one of Wall Street's best kept secrets. How do you actually choose which option you're going to buy? How do they choose? So when we look at unusual options activity and people are seeing all these trades, you're just seeing the trade. There was a process to get to that trade. There was a thought process to pick that exact strike. And that's what I teach. That's what I'm trying to tell everybody, how they do that. The last area where they have edge is in their plan. Most people think it's all about the trading ideas. I try to help people focus not only on the ideas and not only on how you come up with the ideas, but how you come up with a plan. The plan is just as important as the trading ideas. Okay, so those are the 4 areas that the top 1% have edge. Now, 3 Steps to Profit is a system I created that tackles all 4 of those areas. Specifically, I have a tool that takes care of 2 and 3. Simple tool, but powerful, takes care of 2 and 3. I also then show people how to come up with the ideas using unusual options activity, using the same process I use when I come up with my own ideas. And lastly, with the plan, it's all part of the process. That's 3 steps. Winning picks is essentially just my ideas. You're getting my ideas 2 to 4 times per week, and you get the plan and how to come up with your plan, your unique plan. But you're paying for my time and my experience coming up with the ideas. So that's the 2 products that I offer. Here are the results. So people want to understand, okay, so what are you doing and how? These are the results of the last 12 months with simple risk management protocols. March 2019 to February, you see some pretty great results. Fair enough. In the my free membership, I actually give you every trade we took over the last year, so you see what we're doing, how we're picking them. We're not winning all the time. You see a lot of losers in there, but with risk management and playing a game where we're trying to win 3, 4, 5 times out of 10, if I hit 5 out of 10, we're winning a decent amount of money. And we're picking unusual options trades that are trying to identify trades that are going to make 150 to 400% returns. So these are the returns. Now the question is, okay, how do you find these ideas? That's what people want to know. So that's when Market Chameleon comes in. On every day, I have a process, and I start essentially at Market Chameleon. I start at unusual options activity. And what I need to do is I need to take the unusual option activity, because there might be, and every day there's approximately 120 to 200 unusual options activity trades. The question becomes, and the problem for everyone is, how do you actually choose, right? How do you actually choose which one? How do you narrow it down, right? So we have the top 1% is basically the unusual options activity. They're trading the big size, okay? The big hedge funds, because they have more capital, they trade larger, okay? We've established that they are buyers of options, and that's important. The important part of why they're buyers of options is because they're trying to get the leverage, okay? There's an option provides them limited liability, but offers them unlimited leverage. That's really important. That's really what they're after. Okay, but again, the biggest problem is, how do you narrow 200 trades to a select few? So in a second, before doing that, I'm gonna show you some other things, but in a second, I'm gonna take down 136 trades today. All right, they're on the same board. You and I are looking at the same board. I'm gonna take 136 trades and narrow it first down to about 19, and then we're gonna start figuring out how to narrow it down to a few. And from there, gonna take a little bit more digging. The last part I sort of teach at optionsgeek.com and give you the final pieces, but I'm going to show you here how to get down from 136 trades to 19 first in 30 seconds. And then from 19, how to start filtering down and digging into what I call the best ideas in the market. And the reason I say these are the best ideas in the market is because I just showed you that there's a conscious choice by a hedge fund to trade options. So when he decides to trade options, he's telling you that options are a better trade than stock, okay, by default. So let's take a look. Let's take a look at, this is what we're trying to find to filter. Now, what I do is I'm going to lead you through unusual options volume. It's going to lead us into the options chain at Market Chameleon. Then we're going to take a look at open interest quickly, 5-day open interest trends, which I love. I'm going to talk a little bit about Shark's DNA. That's going to lead us ultimately how to get into a target stock price and then a trading idea. Okay, the target stock price and whatnot, that end is sort of what I teach at optionsgeek.com, but I'm going to get you most of the way down that process. At the end, people like to say, what does an idea look like? Felix, you give ideas, you give 2 to 4 trade ideas a week. What do they look like? Well, I try to make them as simple as possible. So I'm going to show you this idea and how it's set up, because I think there's logic behind the setup. I give the trade idea at the top. I give the chart and a little bit of technicals. I believe in less lines, if you will. I believe that, you should be able to tell a story with a chart with 3 lines, basically. No more than 3 lines. It'll confuse everybody. So this chart should tell a little bit of a story. There's clearly a level there at 17 that is resistance, and we got a gap fill to 20. Stitch fix, it goes down, it talks, in every idea, talk a little bit, very briefly, about what the company does, how they make money. Here, Stitch Fix is essentially this new company that has got a new way of sort of retail. It sends you a box. It's like a surprise box, sends you a box. You don't know what's in it. And then you get to return whatever you don't like or keep what you want. And they give you some discounts, try to take the whole thing. What I then show is, again, part of the story was an IPO stock. Maybe maybe it's overvalued. Is it one of these unicorns? I start sort of giving questions to the reader to help them understand how a hedge fund is thinking, what they're looking for. And here I have what I spotted was two guys from Benchmark Capital. Now, Benchmark Capital are superstars, right? This guy, Bill Gurley and Steven Spurlock, they came in over the last month and they bought stock in Stitch Fix. March 12th, they bought 250,000 shares at $12.76, and Spurlock bought 50,000 shares. And then on April 9th, they both bought 1 million shares. Now, what's interesting about that buy? So again, just simple logic. When you usually want to buy the most at the lowest, right? When it goes down, you want to buy the most. Well, what happened here is they bought 250 on March 12th. 3-4 weeks later, they then bought $1 million, $3 higher. So somewhere in those 3 to 4 weeks, they realized something. I don't know what they realized, but as you know, these guys, whether they're billionaires or not, and I've sat next to billionaires, they think similar to you and I, right? If something's going up, they want in, but as it's going down, maybe they'll nibble a little bit. And then when they feel like, oh, it's turned, or, my analyst has gotten more information and we think this is the right time, they're going to buy more. So they jumped in at a higher price, buying 20 times and 4 times more than they did. At the bottom here, you see this call open interest. That's sort of telling me the trends. This is what's been going on. And this is a Market Chameleon photo. What's going on? What expiration dates? What strikes? I show the calls and I also show the puts. More call activity. Okay, 3,000, 2,000, 1,000 options. Not super exciting, but it was on my radar. There's call buyers. And I looked and they were buying calls. But on Thursday, there was a large buyer of the May 1st, 16 calls. So you see that right over here, 10,000, look like about 10,000 calls were bought on May 1st. And again, spotted that on the Market Chameleon site. I was looking for an event. There wasn't any event, no earnings, no scheduled announcement. So the question was, why next week calls and why so many? And sometimes when you're looking at unusual options activity, sometimes no event combined with unusual options activity is the event, right? It's a hedge. I always tell someone a hedge fund manager is not waking up in the morning saying, I just want to go buy 1 week Stitch calls. It's not what they do. It's not how they think. There's a reason they bought 1 week Stitch calls. Do I know that reason? No. But if I know how they think, and if I know what they're trying to accomplish, I don't need to know the exact event they're looking for. It's not often that they come in to buy 1 week calls. And so putting that story together, it feels like something is going on here. Do I know what? No. Can I be wrong? Absolutely. Okay, but I'm trying to find those spots where the stock could jump, break 17, and probably heads right to 20. Okay, to me, this seems like a decent risk reward. I took an extra 2 weeks. You see at the bottom, my advice was to take an extra 2 weeks and say, you know what? I hear you. I don't necessarily like buying 1 week calls, because if the market decides to go down 1%, 2%, it's going to take everything with it. And the K is coming along pretty quickly. I'll buy the extra couple of weeks for a few shekels. Okay. So let's dig into unusual options activity. That's sort of the framework. I wanted to give you sort of what we're thinking about, where we're going, and then the idea and how they're coming each day. So let me stop this share for 1 second. Let's go to the actual website.
Before Felix gets to the website, remember everyone, go to the question and answer section and post any questions there so we can get them to Felix at the end of the show. We'll try to get through all those questions.
All right, so here we are. You guys know this spot.
Love that spot.
What I do here is I simply go options, unusual options volume every day, okay? And what's beautiful about this is you can do this. You can go back any day over the last 2 weeks. That's what's awesome about this. I haven't seen anything really on the market like you guys. That's why I love it so much, is that you're able to dig, you're able to go back. if you want to do research, like I'm telling you what you're going to be looking for. So now you can go back and find it. You can. There's some days I'm on this for 5 hours myself, just looking and digging and digging. So this is what's awesome. So I'm going to show you just with a few clicks, okay, how to get value, okay, immediately. Okay, so I'm on. All I did was I pressed unusual options volume. I'm going to look for common stocks. I don't want ETFs, right? Hedge funds. It's hard for anyone to gain sort of edge on the whole market, right? I know where the market's going. It's hard. I know where the banks are going to trade. It's difficult. It's a lot easier for these guys to say, I know where Micron's going. I know where AMD's earnings are probably going to be. I know how Disney earnings are going to be. That's easier. So I believe it's a core belief that a hedge fund will have more edge in common stock, okay, in a certain stock, specific stock. So I'm gonna close the gap here, common stock. So I just went from, let's just do that again. I went from 136 entries to 112, okay? I'm then gonna go over here and I'm gonna click IV up. That took us down a lot here. We just went to 30 entries. Now, why IV up? Remember, we're looking for buyers of options. We're looking for large size, which is what essentially this has given me, but we're looking for buyers of options, and I'm specifically looking for stock options, okay? So 2 buttons, I press common and I press IV up, and now I have over here, you could see all the positive changes in IV from Thursday to Friday. Now the market was up a little bit, and so market up, implied volatility usually for the market goes down, not for these individual stocks. They went up. It sort of solidifies that thought that there were buyers in these names, buyers of options, and that's important, okay? So I have now 30 entries, okay? Now, I come over here and I press current price because I want to filter that from highest to lowest, and I don't want to really trade options on anything below $10. Okay, because in general, these things are options, right? These stocks, $2 stock, that is an option. Okay, there's no reason to start putting leverage on top of leverage. A bid offer of a nickel in some of these names is a lot on a percentage basis. So I try to stay away. Not that you can't find value. It's just, for me, I'd rather stay away. I'd rather get something that has a little meat on the bone, that is a real stock, that's, you know, $40, $50 stock, that in that zone. Okay, so now I've taken out, if I take out these bottom 6, that leaves me with 19 trades. Just like that, in a few seconds, we went from a whole trove of unusual options activity to 19 stocks that actually probably have some story going on. If I just look at Facebook and Zoom right here, top traders, right? There was, you know, Zoom got crushed in the middle of the afternoon last week because Facebook was going to have a competing product. So that's there. Okay, TDOC, always a name that people are, you know, during this coronavirus, that people are looking at. All of it, you'll start seeing a lot of different things and names that there might have been stories in. But now what we have to do, and this is where we have to dig a little bit, right? So I'm going to just take a look. I know this story, but I'm going to take a look at, and again, I can look at calls versus puts here. So I'm looking at, if I wanted to find puts or wanted to find calls, I'm trying to find throw a put in there and maybe a call, but I'm going to look at a put first. So I just kind of look at this one here. It says 98% were puts, 2% calls, and there were 11,000 options traded. So I want to look. So I just click on that, and what pops up here? The options chain. So right away, I can see where I'm looking right over here, and I can see where the volume was, and it's in the May options. Okay. And then if I look, just move this thing. If I look, I could see that it was actually in the 25 puts. Okay. Now I can click there, or actually I'm just going to go first to open interest. So I go over here and decide, because I want to see, what I'm trying to see is if this is a buyer, right? We're making guesses here. At the end of the day, we're making guesses. So we want to really, really focus on making sure we have the right options. Okay. So, and that's very, very important. And that, again, that goes at the heart of what makes MarketChameleon different. It allows me to go and dig into the data to confirm that this is a buyer or not, or maybe I can't determine. So I'm going to try to do that. So basically what I would do is I would just click on the open interest first, just to get a lay of the land. Open interest is going to tell me a story right here. They're playing in these are the bets. These are where the big bets are. These are where the big guys are playing. They're playing in May and they're playing in June. Okay, now I want to see where they're playing. What are they doing? And it's very clear they're on the 25 line. They're on the 25 line. Now, somebody's going to say, because people think, oh, only if the open interest is greater than the volume, that's when you pay that. I'm sorry, when the volume is greater than the open interest, that's when you pay attention, because that's when you know. But you guys allow me to actually dig, right? So I can click the open interest, and what pops up is this button where I can now dig a little bit, and I can see a story developing. Okay, so I'm developing this story where I see volume here on April 3rd, April 6th, April 7th. And what I could start doing is I can go to the summary area. I could start looking at news. I could start putting some meat on this bone, on this story bone, right? I want to figure out what's going on in HTHD. Frankly, I don't even know what HTHD. I just know that it's a Chinese ADR, and I know that just because it has ADS next to it, and I know that there's a lot of these Chinese stocks that are, after Luckin, coffee dropped 90%, 85%. There's a lot of these Chinese names under pressure. Are they frauds? Are they not? So you're starting to see some of these trades. Now, this one looks interesting to me. So I'm going to dig a little further, right? I'm going to dig a little further. I see this volume, and what I can do here is look at the volume on the day, and I can click on that, and I could start digging. And it shows me every single trade that has happened on Friday in HTHT, okay? And what I'd like you to see is this condition on the side, and it tells you what type of trade it was. Now, each one means a little different, but essentially, I'm trying to find singular trades. I don't really want to find multi-legs. I don't want to find condors. And that's not really what the top guys trade. They trade buy puts or buy calls. That's essentially what they're very specific, and they're targeting a very specific situation. So I'm looking for things like regular auto execution. I'm looking for not multi-legs, although that was only a 2-lot. I'm looking for sweeps, intermarket sweeps. So these things are all telling me, okay, this was a straight buy or sell. Now I got to determine whether or not it was a buy or sell. And here I'm looking at buying and selling. What did the guy do? And I'm looking at how he did it. You see this timeline? It looks like he was here all day, buying and buying and buying. You just go all the way down from there. 9:30, started doing something, whether it's buy or sell, and he was doing it all day. Now, I'll leave you there, but this is one of the most important parts, I think, of the whole process. And I teach how to dig in a little bit further here in the 3 steps and as part of my process. But I want to determine whether or not that is a buy. I want to be as sure as I can. Because if the guy's selling, then my whole thesis about following a shark, following a guy who knows, a top 1%er, my whole thesis blows up, because that was a sell. Right? And people could be selling for whatever reason. Maybe he was selling out. He had 30,000, he's selling out. I won't know from the open interest till tomorrow, but I need to figure out, I need to be very specific. He bought that option. When I'm that specific, I put it on a list. Out of the 19, there's one. I got a buyer here. Okay, now can I match certain other things? I talked about the DNA of a shark. These guys, they buy things very specific, and they're looking at different things. And there's different clues you can get. And I list those clues at optionsgeek.com, and I tell people how to look at the trade and how to find and say, look, there's clues in implied volatility, there's clues in skew, there's clues in a lot of different things that you could start pinpointing and saying, this is interesting, that's interesting, and it develops that story. Okay, it develops that story. So that's HTHT. You have the open interest here. Let's take a look one more time. Lastly, it's the chart that you saw. Okay, I'm looking at the 5-day chart, the 5-day change in strikes. I see here 6,000 in June 1935 and 40 calls, but then I see 25 and 25 puts in May and June. I want to know what these are. I want to dig. The same way we just dug with the 35s, I want to know what these are. Are they selling? Are they buying? If they're selling, it starts making another interesting case. Okay, they're selling calls, and now you see them buying puts. That's a double negative, right? That's somebody that's saying, I'm trying to get out of this stock, and I'm going to let these calls expire worthless. So I want to dig. And again, Market Chameleon opens the door to sort of digging down and figuring out the biggest story. It's not just a high level, oh, this traded, this was a sweep, and that's the one you choose. It's about, that's just the starting point. We're trying to create a story behind it. So again, doing this all evening, I'll be doing this because I'm going to look at every single one. I looked at it briefly before, but here's another one. Let's just, actually I can go back here, okay, because we have our list. Let's look at play. Let's look at play. Play was one of these guys.
Yeah, I think it was below, like right.
What's that?
I just saw it.
Sorry, play.
Like,
here we go. Play. Let's take a look at this. Let's see. What's the story telling us? What's the data telling us? It's telling us, one, it's unusual. That's where we were at. It's telling us, see the implied volatilities all going up. Okay, in the day when the market was up. Is there any earnings? No, it's not till June. So why are they buying 1 week options? And which ones they buy? Now, I also see 7,000 April. Looks like here's that trade. Okay, the 12 calls, 5,000, and the May 1st over here, 5,000. So it looks like either they rolled, okay, or they were trying to take a shot here in the morning on the 24th. Maybe they know something. Maybe somebody knows something's coming out. You know, I don't know. But I look here, and they actually paid a decent amount. This was Friday's options. They paid up to 45 cents. From 5 cents to 45 cents. So it looks like either they came in as the market sold off, and you can just do some due diligence and look at the stock, how it traded during that morning, during the day, and follow these option trades and come up with the answer of whether they bought or sold these. It looks like they weren't a multi-leg trade. It looks like it was a straight buy or sell. So you can actually figure out, it looks like they were selling. I can't go back to the open interest because the open interest doesn't give me sort of where it was, but here I have, let me close this down. Here I have the story. It looks like they have some trades here, but if you start looking at each individual one, you see in May there's not any open interest. So the 12s that they bought look like it's open. Now we got to figure out whether they bought them. You can see here again, every single trade is going to pop up from the get-go. So you got to go back and sort of put yourself in the mind frame of this guy and what he's doing. The market's 50, 65. He takes 65. Take 65, take 65. All in one shot, he's taking these. 948. All in one shot, the market's filling them. Then he pays 75, 949. He's hungry. He wants these, right? He wants to buy them. And he's paying 75. He pays 80. The market's selling it to him at 80. Then he's paying 80 again. And it keeps going, 80, so 85, so 90. I mean, it seems like he's buying. I can get comfortable here that he's buying. I'd have to look at the stock, but another clue here is sort of where the volatility is going. So he's buying this. There's a buyer of play calls. Okay, this is something that I spotted tonight. It happened Friday. It's on my list to look at, to sort of dig through the rest of my process to figure out, is this the one I want to trade? Is this the one I want to go with? You know, to my members and to give them reasoning and to give them logic. I got to dig a little further, and it takes technical analysis. It takes options analysis. It takes some fundamental analysis, not a lot, but some sort of thought process on what is play. You know, play is, I think it's a restaurant, without even knowing, Dave and Buster's. It's the arcade, go to a restaurant. It's, down probably because it's closed and because they've got some debt. And so, what happens when we're about to open up again? Does the stock go from where it was right back to 75% of where it came from? These are the types of things I'll be looking at, along with, like I said, the rest of the process to sort of filter down and then put it all together in a story that I showed you in with Stitch Fix. So 130, this is my job every day, but 136 names down to 19. We've already spotted 2 that seem interesting enough to go with or to look at. What I like, and I don't do enough of, is the screeners, right? So you can then go from options to the screeners, which is, let's go by, stock screeners over here to sort of seasonality and event driven, right? When you have earnings, I know that there's a whole earnings analysis. So these are types of things like when you find the idea, when you find what's going on. In these 2 cases, there was no earnings. Many times the idea is that the hedge fund, they're buying the earnings. They want that earnings report. And so now you can actually take the data in different areas of Market Chameleon and start analyzing the 3 to 5 stocks that you find today to start developing that idea even further. On top of that, adding your technical analysis, adding whatever process you use on looking at a stock, you can put that all together. And there's a lot in all these screens right up here. So given that,
I think we have like a bunch of questions now,
awesome. Go for it. Go for it.
You want to go. And I just want to mention, like, to the viewers, a couple important things that Felix mentioned is, why he's looking for buyers, right? Because a buyer of an option, right? If you're selling an option, you're not really cheating. If you're cheating or something, you're not really going to sell an option because there's no real way of knowing nothing's going to happen in the stock, right? But if you think something's going to happen, or if somebody's cheating, they're going to go buy the option, right? So that's one of the things that I think that you're trying to make a point. And also that it wouldn't be in an ETF because nobody really can cheat or know where an ETF or where the market is going. But if you do your homework in an individual stock, that's where it can make a difference.
Here's another way to think about options, and just in general, the market. I tell people that they buy options when they find opportunity. What does that mean, right? What exactly does finding opportunity mean? Somebody will say, oh, when they could shift the odds in their favor. What does that mean, right? Well, I like to think about it this way. Opportunity, the definition of opportunity on Wall Street is when your expectations, when Dmitrys and Will's expectations, differ from what the market is saying, when it differs. That's the only thing. The only reason someone's going to buy those call options is when they believe that it's priced too cheap. Now, somebody's going to say, oh, 151 vol, because there's so much pressure for everyone to look at the vol. 151 vol. That doesn't sound cheap to me. You know what a hedge fund manager, top 1% guy says? It's $1. I paid $1. It doesn't matter if it was 300, 150, 250, 220, 50, 75 vol. It's $1. And they think about it in risk reward. Risk $1 to make X. Then they have to decide whether or not that's good enough for them to take. That trade is good enough. So opportunity is really when you think something outside of what the market thinks.
All right. So, yeah, thank you, Felix. That was great. And Will, do you want to go to the questions? Because I see there's a lot of questions now. So we have
there's a lot. There's 17. We got a lot of questions, Felix.
Awesome, man. Let's do it.
First one, and this was from the start of your presentation. Someone asked, wouldn't the third question be which option trade type and why? I think when you went through the process, you answered that. But I basically, they want to know when you see something in open interest, again, you asked, and this is one of the things you see when you read your site. It's like people want to know, how does Felix make the decision on what option to buy?
So what's the specific? What is specific?
They said which option trade and why. Like which option would they buy or sell and why?
Sure. So what I'm showing you here is a process to follow unusual options activity. Now, when I have my own idea, my own thought process, my own thinking, then I actually have to choose. Right now, I don't have to necessarily choose. I have someone else choosing. I'm making the assumption that they know which option to choose. They know the risk reward, right? That's one of the basic assumptions. Here's a master of risk reward. He is choosing that option. I see him. I am making the assumption he knows what he's doing. That's a big assumption, but I have to make that assumption to jump. Now, it's different when I have my own idea. When I think, if I'm just looking at play, my own idea, I built an options tool to think, which is an options chain, to think like the top guys in the world. So what I've done, and it's part of my new concepts in option, I've created this concept called the risk reward break-even price. Okay, everyone knows what a break-even price is, or at least they should, but that doesn't really tell you much. I give a risk reward break-even price, which is telling you what I said earlier. It's what the market is pricing in for that particular option. So I would use my tool to say, okay, I'm going to choose by basically having, remember, I start with an idea. Remember the process. I start with an idea. I analyze something. I think maybe it was play. I like play. I think it's going to 16. Okay. How long is that going to take? I got to know. I'm going to say earnings. So I want June. So the question becomes, how do I take $16, the earnings date, and get a strike price? That is the hardest question in options. And that's what I spend a lot of time with. It's called Understand Options in 8 Steps, and it's in my 3 steps. It's a little bit longer than a 2-second conversation, but again, it has to do with risk reward, probabilities, odds, and it's unlike anything anybody has heard.
Very, very, very interesting. Felix, this is someone who is one of our more experienced traders. He's asking, when you show your portfolio or trades, he's wondering, do you disclose the results? Is there somewhere he can see them?
Yes.
He's saying it's all about alpha, right? So he's wondering if you expose it to your, I guess, community, whatever. That was Jake's question.
Yes, I have every trade we took. And by the way, I don't give the trades intraday, except maybe 2 out of 200 trades, 250 trades. I give them after market hours. So Sunday night, I will have a trade tonight for Monday's open. Okay. I mark them very conservatively, meaning if someone comes in and buy, and you can't say, I say, buy this option or buy play options for $1, and tomorrow play gets taken out, or there's rumors and it's immediately up $2, the stock's up $2 and the option's $1.80. I don't mark it as I bought it. It has to be a real price that people bought. So that's one. Two, I have every trade that was taken over the last year at optionsgeek.com in the ebook called Catching the Crash. Catching the Crash, you'll see every single trade. You'll see the entry, the date, the entry. You'll see it talks about stops and the losses. Essentially one winner per month. Not that we have one winner, but one winner per month. When we're trying to win here, the top guys in the world. Here's another thing that the top guys in the world they focus on. They don't want to buy $1. They don't want to buy an option for $1 to make 50 cents. So if I would call Steve Cohen's hedge fund or Elliott Management or Ackman or any of these guys, you call them and say, I got a great idea. You should buy this option. And he says, okay. And we start talking about it. And I tell him the option's going to go from $1 to $1.50. He'd hang up the phone. It's not you don't understand what they're buying options for. They literally, phone just clicks. It's like waste of time. You don't get it. You don't get what we're doing here, right? So they only buy options when they can make 150 to 400% returns. So to answer your quick question, yes, I have every trade that was taken. I have the winners, the losers. And you saw that Stitch Fitch. That was actually the trade from Friday. That was Friday's trade. And we had IMMU, which is Immunomedics. That was Tuesday's trade, that was a Steve Cohen trade. He filed on Friday. Monday morning, you could just look. Monday, there was a buyer of 10,000 calls. I went out with a call on Monday evening for Tuesday. Everyone got in. And, on Thursday, stock, FDA came in with an announcement. Stock was up big. So, we don't win on every trade for sure, but we have logic and reasoning behind the trades, and that's what I'm providing.
Excellent. I'm going to go for a question on YouTube. Orson is asking about the play idea you gave. He was asking, what option were you looking at?
Sure. It's right here. Can you see the screen still? Yeah. May 1st. Right there. May 1st expiration to 12 calls.
There you go, Orson. Awesome. Another question from a chameleon out there. He's asking, do you take implied volatility into account at all when you're diving into a trade? I know it sounds like, a lot of what you're doing is buying calls and puts, following the sharks, the people you've identified as the big traders. Do you then look at the IVR at all, or you just say, I'm paying the dollar for the call irrelevant to the IV?
So what's interesting is, I'm changing the conversation. It's me versus a massive industry, billions of dollars at stake here. I'm changing the conversation from implied volatility in the Greeks to risk reward, probabilities, and odds. Implied volatility is a number that comes from a formula. Okay. And at the end of the day, it's valuable. It's valuable if you're going to trade that volatility. And what does that mean? Well, there's this term called volatility trader, and it's used, in a way that maybe people don't understand what it is. But there's a certain type of trader, and that volatility trader is a valid trader. When I was at the investment bank, the guys that are trading at Goldman. So if you want to be a trader at Goldman Sachs, okay, volatility, the Greeks are everything. Okay, you have to understand them. You have to understand the Black-Scholes formula. But for 99.8% of the people out there, the Greeks aren't going to necessarily matter too much, and the implied volatility is way overlooked at. However, it does give you clues as to what's going on out there. It does give you clues as to what you're paying. The industry would like to say, you want to sell high volatility, buy low volatility. Well, I just showed you a guy who bought 5,000 options paying 150 vol. Doesn't seem like he's buying low volatility. Okay, the top guys in the world are not looking at that. I don't tend to look at that. I tend to look at implied volatility to analyze and to get concrete answers as to whether or not I'm using the volatility to get concrete answers to figure out whether or not there was a buyer or seller. So implied volatility to me is just a number that comes from a formula.
Awesome. It's funny. YouTube is blowing up.
That's not going to make any friends, by the way. That's not going to make any friends. Don't worry. I know it. It's me against the whole world.
No, it's all the IV traders are going crazy.
That's right. I love it.
You have Dante out there on YouTube is saying he made a 900% return on one of your trades last year. So
awesome.
Good stuff.
I talk to people who are in your class, and your trades, like you say, you don't win on all of them. It's impossible to win on all of them. But the idea is to find that trade that's really explosive. Right?
We're going big whale hunting. It's literally, they call them the sharks, but whale hunting. We're out there. I'm out there looking for that big trade.
Yeah.
That's awesome. I guess someone else is asking why no ETFs, and I know Dmitry got into that a little bit, but the whales, I mean, unless it's maybe a smaller ETF, that really doesn't pop up for you at all? Or
you know what? I tell you what, when things were starting to get a little crazy. So look, my members know that on February 21st, on that Friday, I caught the crash that was coming the week before. We caught it perfectly. We made a lot of money. On February 21st, there was a specific technical trade setup that I panicked. I basically, and I don't do this often, but it was one of the very few times, midday, I went in and said, you got to buy S&P puts right now. You got to buy SPY puts. This thing could crash on Monday. And sure enough, it did. And then even on Monday, the HYG, which is the high yield index, the high yield ETF, junk bonds, essentially, that was still hanging up there. And I jumped on that one and said, we got to buy as much as you can on this. So, ETFs, I generally stay away. But when market's crashing, there's a concept called correlation. Everything trades correlation 1, which means everything is priced ultimately the same. Things are moving the same. The SPY is moving up and down 5%, but it's costing X. Then something that's cost 2X is moving up and down 10%. Everything is sort of priced the same. So I stay away from the simple answer is try to stay away from the ETFs because, like you said, there is no edge. But on occasion, if I need a quick liquidity, or I see something really mispriced, I want to get short the market in the cheapest way possible, without picking the volatilities already picked up in the single names. I might just grab, it's a very specific moment. I might just grab a SPY or HYG.
Right. Cool. Especially during money panics, you see a lot of this.
Of course, you want to go fast. You want to be in there and bidding for a single stock. The single stock options get wider. It gets harder to get out. The implied volatility goes up a little faster. So that's when I use it. But remember also, think about the process. Let me show you one thing here that I wanted to show you.
Okay. And just so you know, we're having a lot of questions up right now. So
I'm willing to stay here. I live and dream this stuff. Hold on. All right, let me show you this. Hang on. All right, so what is this? This is basically trying to tell people, look, unusual options activity it's data, right? It's showing you where the good ideas are, where the big trades are happening. Okay, so you get to see it there. I'm an expert in analyzing the data, but my experience at the hedge fund and the investment bank, okay, and the process, right? Unusual options activity starts where, and people need to understand, it starts with somebody coming up with an idea, okay? The hedge fund comes up with an idea. They analyze this idea. Now, what does that mean when they analyze this idea? Let's think about that. Well, there's there's books, that are written about Black Edge and about these consulting groups and about how they hire people to give them insights onto the trends and whatnot. Well, that all goes in. There's a lot of money, manpower, there's man hours in these ideas. That idea eventually gets to a hedge fund manager who then decides, okay, I like the idea and we're going to use options. And then when they use options, they got to go to an investment bank. Now the investment bank's got to put up the trade. That was me. I was sitting on both sides. I was the hedge fund trader and I was the investment bank trader. So now you got to go to the investment bank trader, and that trader has got to put the trade up. There's a process in there within that hedge fund and invest. There's a process of negotiation, right? There's a reason why things trade the way they do. And once it trades there, it goes to the exchange and eventually hits, the unusual options board. So again, I basically say, you see this, I'm trying to explain to everyone what's behind that curtain. Okay, so that's important. That's very important. That whole beginning to end process is very important.
Well, do you want to?
Yeah, I got questions that are overlapping on from YouTube and from Jake. Any rules for exiting positions?
Sure. I exiting, entering. Again, I said it in the beginning. Ideas are people. Ideas are important, obviously. The trading plan is just as important. And very few people spend equal amount of time on each, right? It's like you need to understand your plan and you need to understand the idea. So I do go into detail on how to build a plan, how to think about a plan. So Options Geek members know before the trade is, the last, know what, well, let me take a step back. A lot of people still email me saying, what do you think now? Right? Stock's up 150%. Now what do I do? That question, I tell people I don't even answer those emails. I answer all my emails except those emails because I have to train people to understand that you already know the answer. The answer is that I'm going to give you is, what's your plan? Okay, now I do give sort of logical reasoning as to what the average person should do. But at the end of the day, I'm not Will, I'm not Dmitry. Dmitry may have a little bit more gamble than me, and Will, you might be the most conservative guy in the world. You're not going to want to trade it like Dmitry. If we're trying to pick the whale, and some of these trades, they go up 1,000, 2,000%. Okay, it happens. And if you start getting out too early at 100%, 150 and 175, you're like, I just made 135% on my trade. Well, guess what? This one went up 1,000%. Okay, so how long? We're never going to catch the bottom, the low on these option trades, and we're never going to catch the high consistently. Every once in a while, I get lucky. But ultimately, what we're trying to do is simply live in the middle and try to take off as much as we can in pieces. Now, do we know when, or are we trying? I'm trying to reduce the guessing while the stock is moving, because then you got emotions. Then the stock is up. Look at IMMU, Immunomedics. Stock was up 160% on Thursday, came off a little bit intraday, and then shot back up on Friday. There's no reason why anybody should panic and get out of the position because it's up 100%. Remember, I told you, these guys are not buying options if they can't make to 150 to 400%. There's no reason to panic. It's hard to get people to be trained in that way, to think if we spot the guy and we got the guy in and we have the same trade on that guy has on, there's no reason to panic up 75%, up 100%. At 100, I say, and I'll give you this, at 100, I say, take off a third, because it becomes very difficult to lose. The math is simple. It becomes very difficult to lose if you take 1/3, if you take 100 or 1/3 off at 100% marker. What you do with the rest of the trade is fine. It's up to you. You can use 200, 300, 400. You can use 175, 250, 350. I teach people how to figure it all out, but it becomes a conservative versus aggressive approach. So each person is unique.
Great.
By the way, we're just to let you guys know, none of us are investment advisors. We're not. You gave that disclaimer, right? Well,
well,
yeah, you got it. Every trade I give loses.
But
there's the disclaimer. If everyone sees it behind me, you see it.
Just sharing ideas.
There it is. There it is. We're not registered investment advisors or broker dealers. Any questions, consult a registered investment advisor. I'll leave that up behind me for the rest of the show. A couple questions about the order flow, and I think people are interested because Felix saw it professionally. Dmitry, you may have some insight in this. People are asking, can't the big guys just hide what they're doing? Is all the orders shown on Market Chameleon? We have a series of questions like that.
Yeah, they can. And the bigger they are, okay, so let's talk about that a little bit. So one of the bigger guys, like a guy like a Bill Ackman, he'll come in, one of his famous trades was HLF. Okay, so sure, he can come in and buy puts. And when he wants to buy puts, he wants to buy 40,000 of them, 50,000 puts. Okay, but when he wants to come in and buy 50,000 puts, me as the investment bank derivative trader, I got to sell him those puts. Now, when I sell him those puts, what else do I need to do? I need to short stock, okay? Because I got to hedge myself up. Now, if you're going to buy 40,000 puts and the delta on that is, call it, and I'm getting into a little bit of volatility trader because it's an investment banking type of question. If you're going to buy, 60 delta puts 40,000 times, that's 2.4 million shares that I need to sell short, okay, in order to put you up. Now, if I go to the market and do that trade, meaning Ackman says, I want to buy 40,000 and I want it to be printed wherever, I'm going to basically say to his trader or to him saying, I got to price in my delta risk, which means I have to short 2.4 million shares at the price you see on the screen, which isn't going to happen. And I got to short 2.4 million shares. So I need to borrow and I got to short the stock. It's just not going to happen, 2.4 million shares. It's a block trade right there. And so what happens? So that's there. That's where the negotiation starts. And it basically says, listen, Bill, I'll put up to 40,000 options. I'll sell to you. It's on the screen at, let's say say he's looking at puts, but it's on the screen at, I don't know, $2 to $2.20 HLF puts. And he says, yeah, I want to buy 40,000. And I say, all right, I can't sell them to you 40,000 at $2.25. However, if I get my stock off at X price right around here, and I'm going to be shorting for the next, 2 days, if I can short my stock and I'm going to give you my reports on stock, then I will do a trade with you, OTC, Bank of America to Pershing Square. It'll be a contract between us. Nobody will see the trade, okay? And we'll put up 40,000 contracts and I'll sell to you at 2.5, okay? Because he likes to trade on the downside. I actually like the volatility that I'm selling. Two different games. See, he's betting on direction. I'm betting on volatility. Once I get my delta hedge off at a certain level, I lock in that volatility that I'm trading. I think that's a great volatility to sell. I'll sell it, no problem. I'm taking in a lot of risk too. I'm taking in the risk because I want some of that risk back. So we have this trade on, and what happens is you'll start seeing me as the investment bank derivative trader go into the market and start trading delta neutral. I'll start trading, maybe I'll trade 6-month options versus he bought 1-year puts. Maybe I'll trade 6 month. Maybe I'll trade, I'll buy some gamma. Maybe that goes into the Greeks. That goes into sort of the risk management. Okay. And so, yes, the answer is yes. When they're buying such big size, 40, 50, 60,000 options, and they can move the market or they don't want anyone to know, they can just call up a bank and simply say, let's just do this. It's called OTC and nobody sees the trade. And you could quietly, Felix, short some stock if, I'm buying puts. And if I'm buying calls, you can quietly go buy stock and we'll mark the trade as it comes, at the end of the day. So today you bought 10,000. I wanted buying stock here. We're going to reprice the option instead of 2.25 to wherever I bought the stock. And we're going to adjust it delta neutral. That's how they do it. So yes, the answer, long, short, they could do it quietly behind the scenes. Many times they don't because they also want to be able to get out. There's paperwork, there's contracts. You have to have an ISDA for some of this stuff. So there's a lot of stuff that goes on. And again, you get in bed with a guy, he's got to give you the right price coming out. Okay, so that means if I enter a contract, somebody enters a contract with me, or I'm at the hedge fund and I go to Goldman and I buy this huge trade, I do this contract, then I have to get out through Goldman as well. And, when things go bad, you have a contract. I have to get out. I can't get out with anybody. And maybe they didn't give me a clause in the contract that says I can go transfer this this contract to Bank of America, and it can be fungible with their contract on the way out. So
Right,
there's a lot of things going on with
the-
that.
Right. The risk of the over-the-counter is that you're doing a trade with one counterparty and you
That's
have
right.
to get out with them. So
That's right.
it's not like going to the market where you have lots of market.
That's right. Where you have other things going on. That's right. More
Right.
liquidity.
Well, you want to?
More
Cool.
questions, huh? Rob Barr is asking, do you put any trust into dark pool trades?
You know what? I don't talk about things that I'm not an expert in. And I would say that I know that people look at dark pool stuff. I don't know. I'm not an expert there. And I don't know. The answer is I don't know. It's one area that is a little foreign, especially in the stock. To me, it's mostly stocks that are in dark pools. I guess now there's probably more and more option trades going in there, the smallest, but that's something that I don't know a lot about, to be honest.
Well, let's leave it there. Bob is also asking, when do you look at the unusual option activity? Is there a time of day? Do you start at the open? Is there a particular time of day you look at it?
I usually let the day develop, and I usually allow, I only give trading ideas during closed hours, and it's done on purpose. There's a reason. I want people to focus on their plan, their strategy first. I want them to know what they're going to do, how they're going to attack the trade. I want them to have a plan, and I want everybody to start at the same spot. I give a trade during the day because I see something and everybody's racing for it right at, the people who are at work. I have a lot of people that are doctors, lawyers, accountants, that they don't have the time to look at the market during the day. And all of a sudden they get home and they're like, there was a trade and they missed it because they're working. I give my trades usually in the evening or by 6 a.m. in the morning, so people all get at the same time and they can all start from the same place.
Awesome. I think we'll leave it on that. You have anything to say, Dmitry? Hey, Felix, thanks so much for coming today.
That was great. Thank you so
No
much.
problem. So, one thing I will finish off with is that I made it easy for everyone to sort of jump on board. I priced a package where people get brand new education, brand new concepts, and they get access to a simple yet very powerful tool that gives them the answers to which option they can buy. And I've added 1 month subscription to the winning picks for a very low price to get people to see all of Options Geek. And if somebody wants to continue on with the winning picks, then that's a subscription. But they get a look at the winning picks, the subscription, they get a look at all the education and the use of the tool. That's lifetime, that's one-time payment. And I think it's a great package, all for the price of for the price of a New York City lawyer for an hour. 25 years of my experience for a New York City lawyer, for an hour with a New York City lawyer, barely.
That is awesome. And I will send out a link with this video to everyone who is registered for today's show. We had tons of participation, both on YouTube and on this webinar, which was done on Zoom. Any parting words, Dmitry? Anything?
Thank you everyone for joining us Sunday. Felix, thank you very much for for the presentation and sharing your thoughts.
I'm sure we can probably have Felix on again in the future. I know we got a ton of questions still coming in.
Yeah,
anytime. I'm free anytime. I can talk. We can for the next time we can talk at whatever level. If people want to talk about volatility trading, we could switch it to that. It's not really what I do here, but I can. Feel free to talk about that and describe certain things there. So
yeah, that's awesome. Before we go, I'm going to put the disclaimer up one more time. None of us are registered investment advisors. Just be aware of that. And thanks for joining us. We're going to have a show next Sunday and hopefully every Sunday until the end of time for Dmitry and I. What do you think, Dmitry?
Yeah, awesome. Yeah,
good stuff.
Awesome.
Thanks again,
Thank you,
Felix.
guys. Thank you so much.
Have a great week trading, everybody. We'll see you next Sunday.
Take care.
Thanks.
Bye.